Good morning, everyone. Welcome to this update for global stocks for the 25th of June. The uptrends in global markets continue, not so much in Australia, but certainly overseas, and there's really no signs of any change. Just a quick review of what is in this update. I'm going to be looking at the US technology sector, which is obviously a really important driver, and posing the question whether the sell-off is over. I want to have a look at why I think the market will keep advancing medium term and beyond. And I guess that's a constant subject to be reviewing. I get questions from time to time from people that are waiting for the next significant correction. I really want to put that concept or that idea into sharp perspective, because frankly there are no benefits for waiting for the next significant correction. It's a nice comfortable idea, but it's actually something that's not a really good idea at all. And I'm going to just have a look at what's been happening with gold. I've been showing you a setup on the gold chart, and it's playing out in pretty much textbook fashion. So let's get into it. American stocks, the S&P index rose by 5 on the week, so pretty mild. Just continue that really tight trading range. Is the technology sell-off over? Look, I don't know. Might be, may not be, doesn't really matter, because it's technology where the earnings growth is. There's a few other sectors as well that are seeing good earnings growth, but no more so than technology. And while ever the earnings growth is as strong as it is, then any downside in the sector should be quite mild. And there's a lot of rubbish written about the valuations in the technology sector. So you just got to be very careful about what it is that you read. Now, we are seeing a continuation of the rotation of money, and that's a really important sign. The fact that technology, which has been leading the market for so long now in such a robust fashion, is going through some sort of retracement or correction. We don't know what it's ultimately going to look like, but it is going through some sort of correction. Money's coming out of technology, but it's not coming out of the market, and that's the key point. It's just rotating into other sectors. And we certainly saw some improvement in the biotechnology sector in particular, and financials are also getting the benefit as well. So this is a real positive for the market, can't be underestimated. The key underpinning factor for the American market, for any market in fact, and I constantly refer to this, stock prices are based on forward earnings estimates and current earnings estimates. So it's based on the good, solid building blocks of why the stock market exists. All the media want to focus on is whether Trump is going to be impeached, or whether North Korea is going to launch a nuclear weapon, or something's going to happen in the Middle East, because that's sensational. It sells stories, but that is not what drives the market. The media would have you think that that's what drives the market, but it's not. It's good old solid earnings. And the earnings estimates for Q2 for America, which start next week, or it might even be the week after, I think, are showing or pointing towards a 7% rise. And that's quite tidy from the second quarter in 2016. Now the S&P has gone up by 8% in the last period, yet the PE ratio is only up by half a unit. So the S&P is going up with earnings. It's not going up on speculation, which again the media would have you believe. And the forward earnings estimates are for an 11% rise in earnings for the S&P as a whole into 2018. Now, typically in America, forward earnings estimates are always a bit on the conservative side. It's a game that gets played in America. You have relatively low expectations, and then you go out and beat them and the market cheers. That's just the way that the US market operates. So if the average earnings estimate for the S&P is 11%, then imagine what the earnings estimates are for the sectors that are seeing the most robust earnings. So that's why I'm not fearful about a significant correction in the market, because it's just being underpinned by such a solid foundation. So let's take a look at the American market. This is the S&P, and you can see just we're at the same level that we were at on the 2nd of June. So we've now had 3 weeks where the market has not changed. It's just gone up and down in a little tight range. You can see the blue line, which is the 50-day moving average. The green line, which is the 20-day moving average, are still pointing up at a significant direction, at a significant angle, I should say. The price is above both those short-term moving averages, and those moving averages are actually still fanning out from the red 200-day moving average. So this is all just screaming strength in the market. So there's really no need for concern at this point in time. And as I've said many times before, you trade what is until it ceases to be the case. Let's just take a step back. So I want to address a question towards the end of this short video. Let's go back to the last time the last 2 times that there was significant concerns in the market. This is 2011. There were all sorts of things happening in 2011 that convinced many people that the market was going to fall over and that we would go back down to the GFC lows. So here we are at around about 1100 in August of 2011. So that's 6 years ago. The S&P index has advanced from 1100 to 2400 in that period of time. And there's been, I know for a fact, there's been a huge number of people around the world that have been sitting waiting for the next big dump in the market, the next big correction. Well, guess what? They've missed out on the market going up by a huge amount. So just keep that perspective in mind. Now, the last time we had some real market wobbles was September 2015, which then sort of followed through a bit into January and February of 2016. Looked like we got a false break, but then the market just regathered its feet and off it went again. A lot of this was around the fact that oil was plummeting and oil stocks were getting absolutely smashed. And that just cast a real negative over the whole market. But as you can see, the market has advanced from 1900 or thereabouts to 2400. So it's put on another 500 points, or about 27% in the last 18 months. And the question you got to ask yourself is, do you want to miss out on those sort of gains? My answer quite clearly, of course, is no, you don't. Now, I just want to look at a couple of the sectors. I don't look at US sectors very often, but this is technologies. This is the US technology ETF, and you can just see just how robust this has been. We had a significant rise from around 32, got to 43. We then went sideways from February 2015 until July of 2016. So there's about 16 months where the market went sideways, or the sector went sideways. And then from there, we've moved from 44 to 56. Now we're getting a bit of a slowdown in the advance, but my goodness, I mean, that's just normal. But if you step back and you have a look at it, the 50-day moving average, the blue line, is still fanning out from the 200. This trend is not rolling over yet. The price is still above the 50-day. The price would have to come down and break the 200-day before there'd be any suggestion that the technology sector was going into a more significant correction. Now, is this it? Is this the pullback? Or will there be another bit of a leg to the downside? Or what is more likely, will the technology sector just grind sideways in some sort of sideways band for, the next 3 months, 6 months, possibly even 12 months? I don't know. And nobody else does either. So we're going to see that. That's entirely possible as well. In fact, I think that's probably the most likely outcome, that we get a catching up, if you like, by the technology sector moving sideways in a range rather than necessarily down. So, this comes back to the question: do you want to sit out the market waiting for the next big correction? Because you might be waiting an awful long time if you do. So there's the technology sector. Now let's look at, this is the biotech sector. Now biotechs have been beaten up a fair bit in recent times. They peaked out in 2015 at 90 and they fell to 45. So there's a 50% loss in value in biotechs. But you can see from the lows in February of 2016, they've worked their way back up to an obvious resistance level formed by this previous peak here. We had one attempt at breaking through, two attempts, and now on the third attempt, you can see we've broken out. And that's essentially what's gone on with this rotation. You can see the volumes have lifted dramatically. So certainly biotechnology is offering some opportunities, and of course members will be absolutely across that. Now turning to the US dollar, formed a bit of a base here, hasn't really resolved itself, so we can't say too much more about the US dollar at this stage other than it may have stopped its slide and the next move may be to the upside. The Australian dollar, we've moved back up into the upper band, which is really consistent with the US dollar going down. But of course, my view is that the Australian dollar will head lower over the medium to longer term. The ASX 200 has really done nothing. We're still stuck in this level that we've been in now for a long time. So we can, let me just unlock that chart so we can pan back and see just how long we've been at this level. We were here in 2007. We're obviously still here in March 2008. And we've been at this level now since 2014, with a bit running to the upside, quite a lot more to the downside, and we're still stuck here. And with the outlook for our local banks, it's really hard to see how our index is really going anywhere. So summary of Aussie stocks, the Aussie dollar is back a little bit, but the big picture's down. The ASX 200 was lower by 60, and I think it's recognition, because the banking sector forms such a large part of our index. It's recognition that our bank valuations are just not consistent with their outlook, and I've talked about that ad nauseum for a long time. There's not many gainers locally. There are some, and again, members are seeing the benefits of that. But nearly all of the gainers in the Australian market have global businesses that are built around smart technology. There's not too many of the stocks that are doing well that don't fit that sort of criteria. So that's where you need to focus in the Australian market. And absolutely beware the blue chip household names, because many of them are in industries that are facing severe competition. And I've mentioned a number of those in previous weeks, but think stocks like Woolworths and Wesfarmers, for instance, and of course the retailers, Harvey Norman and those sort of stocks. So the landscape is changing. Turning now to precious metals, gold rose by $4. That was after it had dipped, so there was quite a nice recovery in the back half of the week. GLD holdings only slipped 2 tonnes from 853 to 851, so that was a pretty good performance. So the ETF sector is remaining very resilient, which is a good sign, because it's the longer term investors which sustain bull markets in precious metals. They're in the ETF market. The speculators in the futures market do not sustain bull markets. That money changes direction far too quickly because of the leverage. So it's the ETF market that's really important. It's only the futures market that dictates the short-term gyrations. Precious metal stocks, as you'll see, bounce nicely off the bottom of the channel, and also some better volumes feeding into the sector towards the end of the week. So let's take a look at, first of all, silver. So a little bit of a bounce in silver, but you can see it's largely been going sideways now for some considerable time. Looking at gold on a weekly chart, you can see we still need to break through this downtrending channel, which is getting lower and lower. And I'd like to see a breakout, a close above 1300, and then of course ultimately above 1400 to really indicate that we're back on track with a new bull market. Let's look at the daily chart, and this is a chart that I've kept as is now for quite a few weeks since before the Fed decision, pointing out that the lows in the gold price occurred around about the same time as the last Fed rate hikes. There's the one in December, there's the one in March. We didn't quite get to the trend line, but in technical analysis, nothing is perfect. But at this stage, you can say that question mark might almost be looking like a confirmation at this stage. So all seems to be reasonably in order in the precious metals market. This is GDX. Again, I haven't changed this the notation on this chart from last week. It's bounced nicely off that lower support trend line, which is rising. So we've basically got a wedge which, if it means anything, will ultimately should break to the upside on GDX. Other commodities, copper was up a bit. Crude oil got another heavy whack, down to 42 before a little bit of a bounce on Friday. My target of 42 to 46, of course, we're clearly right in the thick of that, and we've touched the bottom end of it. And stocks which showed some real promise last Friday night, the Friday before last, resumed their downtrend during the week, and the sector is still under pressure. So be very, very careful in the energy sector. There's the spot copper chart showing a little bit of a blip up. So the current positioning, markets have just kept rising, and as I showed close to the start, if you've been waiting for the next big correction, and many have since 2011, then just look at what they've missed out on. They've missed out on more than doubling their money at the index level. You can't afford to miss that sort of market action because it doesn't come around every day. There's been literally dozens of crisis events. Just think about what has been thrown at the market since 2011. It's a staggering list, but what has happened? The market kept rising, and it just kept going and going and going. And every now and again, we got a little pause for a month or two, and it just went on again. And again, this is not speculative activity. This is not the market going into some sort of blow-off phase. There is no euphoria. There are still a lot of people that are cautious about the market, and earnings are growing, and the global economy is improving. There is no reason that markets cannot continue to grind their way higher. Okay, there will be the odd correction here and there, and it might only amount to 5%, but markets are heading higher. Until they change that direction, then that's what you should stay with. So I just want to address the question, because I do get these questions or comments from time to time from people that correspond with me. If you're waiting for the next significant correction, it's a comforting idea. I get that. I really understand that it feels nice to be able to buy into the next correction. But let me give you a few questions to ask yourself. How will you know when the correction is finished? We can only know that 3 months in arrears when the market has risen significantly. So how are you going to know when to start to get in? Is someone going to ring a bell? And once you do start buying, if you do have the courage to buy at the bottom, then what will you buy? Because not everything bottoms together. Let's go back to 2008. This is a perfect example. So we just wind back to 2008. So the bottom in the market occurred in March of 2009, yet some sectors of the market started turning up in October. Precious metals was one of them. If you look at the chart of quite a number of major stocks, they started turning higher before Christmas in 2008. Yet the market went significantly lower at the index level for another 3 to 5 months. So if you picked the wrong sector to get into, you could have lost significant ground in that period before the whole market bottomed. So come back to the question, what will you buy? Because not everything is going to bottom together. How will your psychology battle the media storm? Because I can tell you when there's been a 10% plus correction in the market or 20% correction in the market, the media is absolutely going off. You will not find a positive article anywhere. How will your psychology deal with that to find the courage to buy into the market? You know, it's a comforting idea. It just doesn't work. And then what will you do if you don't pick the bottom? What are you going to do? You're going to wait for the market to bounce back to where it was before the correction and then start to buy in which case you got to ask yourself, well, what's the point? You know, what's the point of waiting for the next big correction? So what's a better idea? Well, you should always be thinking about risk first and foremost. Again, most people that correspond with me, they're only thinking about the potential upside. They're not thinking about the risk. And last week, if you didn't see last week's video, go back and review the last slide on last week's video where I outlined what you can do to minimize risk and leave the door open to the upside. There's a number of very straightforward things that you can do. So my overwhelming advice, until we see a change in character at the index level, and there's just nothing remotely like that, and there's nothing remotely in the fundamental setup of the market that would suggest that we're anywhere near a top. So just get on with it because the market is still rising. The S&P 500 index has risen 218% since 2011, while many investors have waited for a better time in inverted commas. So this idea of waiting for the market to correct and then you're going to do all these wonderful things just might seem like a good idea, but I can tell you that it's not, because it's extremely hard to do if you're not a highly experienced market trader. That's it for this week. There's my contact details. There's certainly been a lift in the number of emails I'm getting from non-members at the moment, so that's interesting. And just recently, in the last week or so, I produced a video as part of a series that I'm doing to help investors, just get started on the right foot, I guess, because there's such a mountain of information out there. And I know what I, had to battle with for the first decade when I had no idea what I was doing. So I'm just, trying to help people get started on the right foot. But there's certainly been a lot of feedback to that video that I did on covered calls. I must say there's been predominantly misunderstanding. There's been predominantly confusion. There's been a whole lot of fairly, negative responses to, well, not so much negative, but certainly not positive responses to the covered calls. So it really shouted at me that there's a need to get a bit more understanding just about what covered calls are. So I'm actually going to start a process where I'm going to take you through some actual real transactions using covered calls, using a couple of the world's biggest stocks, and I'm going to run it over a period of 3 months or maybe a bit longer. I don't know. We'll just see how it goes. But just actually take you through a journey of how you would actually do this. So if you're interested in regular income generation, then keep a lookout for that series starting. That's it for this week. Cheers.